Good evening, everyone. My name is Hovig. I'm with LBC Mortgage. I'm one of the lead trainers and underwriters at LBC Mortgage. Just to give you guys a little bit basics, I don't want to waste much for your time about my background, but just so you guys know, I know a little bit of what I'm talking about. I've been in the business for since 1995. I've covered the business from all aspects of it, from wholesale to retail, from correspondent lending to warehouse lending, and everything in between. So I know I know where the market is. I understand a little bit about the market. My background is a CPA and has been in education, but I've got two passions when it comes to the business world. The first is mortgage industry, and the second is day trading and analyzing the futures market. And I'm going to be using those two passions to hopefully add some value to your knowledge based on today's webinar. So you could take that with you and hopefully profit with it coming the next 6 to 12 months. So that said, the couple of products that we are working right now, the main ones that we are seeing the market direction that's headed are the no down payment programs and alternative type of programs compared to regular conventional and FHA type of programs. And those are the ones that I'm going to be talking most. But today, just focusing on the no down payment, 100% financing program. So that way, that's the main market going forward, I think, the next several months, plus the alternative programs. Basically, those are solution-based programs for self-employed borrowers, borrowers who can't provide their tax returns, and so on and so forth. So let's dig in. Just so you guys know, again, today's webinar is going to be about the 100% financing program. We do have several options, but just so to keep it simple, I'm going to mention the options, but I'm going to focus on one option today, so that way you could take that with you. At least you have some knowledge with it. But keep in mind that there are several options for 100% financing. All right. So the 100% down payment program is basically known the first-time homebuyer assistance program, although there are programs that the borrower doesn't have to be a first-time homebuyer, so they could have a house and buy another one, for example, with no down payment at all. So there are programs like that, but the majority of the myth out there in the industry is that the 100% program is government aid-based program for first-time homebuyers. Yes, that program is there, but besides that program, there are multiple other programs that are available, more flexible, faster closing, and more advantageous to the borrower. Okay, and one of those products I'm going to actually cover today. So again, we'll cover the available programs, the requirements and qualifications for the programs, planning and mortgage journey. I think the most important, most borrowers or most buyers put emphasis on number one, and they don't put enough emphasis on number three. But I think the number three is the most important item in here. The program, the products are there, but if you're not planning ahead to qualify for that program, then you're never going to be getting that program. So it's sad to see so many borrowers sign a purchase contract, a binding contract, without even knowing if they qualify or not. You know, that's something we don't recommend. In fact, most of our approvals are 100% guaranteed. They're 100% underwritten. So if a borrower goes into a purchase contract, that means that property or that purchase is going to be closed within the time frame that we promised, assuming everything else goes well in terms of the value, the appraisal, and everything so forth. But from the income and credit perspective, we underwrite the file 100%. So there are basically three main down payment programs. There's the CalHFA program, which is a true government-based program. And there's the DPA down payment assistance program, where the second is there's a payment for the second. And there's also down payment assistance program where the second is forgiven. Now, today, I'm just going to focus on a little bit on the down payment assistance program and the down payment assistance forgivable second. I'm not going to focus much on the CalHFA because these two programs are more flexible and more attainable for our market. So again, CalHFA, it's there. I'm not going to waste too much time on it. I'm just going to let you guys know that it is available for the borrower. It's 100% financing. CalHFA is basically FHA first and 3.5% second from an institutional lender. And depending on the CalHFA program, that second mortgage could either be forgivable or it's amortized over 10 years and there's a payment, and that payment goes against the debt ratio for that property or for that loan. Okay, so that's again, there are two types of CalHFA. I do not want to spend too much time on it. This is the regular one where the second is not forgiven, and this one the second is forgiven. Okay, so the borrower doesn't have to pay anything for the second. Let's move on to the programs that I think it's really fits for our market in Los Angeles and the surrounding counties. That's the no down payment program, and we have a program with just 1% down, meaning a borrower has to come in with just 1% of the purchase price of their money. So let's say the purchase price is $500,000. Borrower has to come in with $5,000 of their own money. Okay, so that's actually a really good program, which I want to cover that today. And let's move on to that. Okay, so the 1% down payment program, we call it LBC Mortgage 1, just basically meaning the borrower has to bring in 1%. This one, the reason it's good for our market is we can do this for 1 or 2 units. And 1 unit, we are maxed, unfortunately, for the loan amount of up to $647,000. But for 2 units, we can go up to 800. I believe it's 828,700. So this one, it's pretty good. And in terms of it does have income limitation, and I'm looking at for Los Angeles County, it's $112,000. But if someone wants to buy a 2-unit property, let's say in a decent area, I'm not saying, let's say you're not going to find an $800,000 2-unit in Burbank, but some other areas, you could get a with 1% down payment, and you could rent out the other, live in one as an owner-occupied 2-unit property. Okay, so this program, again, it's 1% down. One of the most advantages of this program is the first loan is 97%, and there is no mortgage insurance on it. So with the CalHFA, there is a mortgage insurance. So that means your qualification or your affordability will be lower based on your income, because that mortgage insurance is going to hit your income in your debt ratio. With this program, you could stretch yourself to even higher loan amount, because you don't have the mortgage insurance, so your income goes further to qualify you for a higher loan amount. Okay, so that is the biggest advantage for this one. This is a great product for example, in Palmdale area, anywhere where the property values are still affordable. Currently, it's only available in several counties in California. So I could tell you guys exactly where, but if you guys are interested, just email me. But Los Angeles County and Orange County is one of them. I know Temecula area is there's a good market for this. I've got a couple of realtors that all they do is target this program in that area. The reason being, it's faster. It's not a faster closing, but it's faster and easier underwriting on our end, and it's a faster and easier approval on our end because there's no mortgage insurance. We know exactly what we're getting into it with the loan amount and the borrower's income. So, and the minimum FICO on this one is 660. Okay. And one more advantage for this one is that the second mortgage, the 2% second mortgage, is forgiven after 3 years. So the way it's forgiven, it's 25% 2 years. The first year it's forgiven. Another 25% the second year, and the remaining 50% is forgiven after the third year. So this is really good program. We do a lot of it. It's unfortunately not too many people are aware of it. So it's the realtors who are opening up this program to their borrowers, having great success. One of the reasons also being is borrowers are able to keep more of their cash rather than putting in for down payment. Let's say borrower is looking into purchasing with 10% down payment. Let's face it. It's between 10% down payment and getting 100% or 97% loan. The mortgage payment, there's not much difference there. So, and it doesn't give the borrower any incentive to put that much more down. That's 7%, let's say more down to get a little bit of a lower payment, unless they're borderline with their debt ratio. But in most cases, it's great. Most borrowers do have the money on this one, to be honest with you. They chose to keep their money rather than putting it for down payment. Okay? Especially if they're going to be putting only, let's say, 5% down or 10% down. If they were going to put 20% down, that's a different story. All right. So again, just to recap this program, I know I'm going a little bit fast. The borrower has to come in with 1% of their own funds. We can do 1 to 2 units. There is no mortgage insurance on this one, which is great. There's the only limitation is the income. We have to match the moderate census tract. Low to moderate census bureau. And for LA County, again, it's $112,000. I'm looking at this is great for Northern California too, by the way. But again, the houses there are expensive. Even though it says Santa Clara County, it's $208,000. But let's face it, the house prices are there so high that that doesn't really matter. FICO is 660, and the second mortgage is forgiven after 3 years. That's another good thing. It's you can stay in the house for 3 years, refi it after the third year, and get rid of the second mortgage. Okay. Or even if you don't refi it, it automatically is forgiven. But let's say you got the mortgage today, and 2 years later, assuming rates went down really crazy, right now your rate is 5%, and 2 years down the line, you could refi and get, let's say, 3% rate, and it saves you a lot of money per month. You could do that but after 2 years, you still have that 50% left to pay to the bank of that second mortgage. Okay, so if you guys have any questions, I believe we are using this. I think this is the Zoom webinar or Go My Webinar something. My technical guy put all this together. I'm not seeing the chat room here. I'm sure there is a place on your screen where you could send me a question or anything. If you have any questions, feel free to send it over. Just gonna get. Now, the second program that I want to talk about is, again, I've chosen the programs that are more flexible and applicable for our market, in today's market, okay? This one, I've chosen this one because it could go up to loan amount to $947,000, and it's a first and second. Again, the second is it's assistant program. So let's discuss this one because this one has two options actually. If we stay within the loan limits of $647,000, that's the conforming loan limit, then the second mortgage on this one is forgiven. There is no payment. It's a zero interest. You just have a second sitting there, but it is forgiven after a certain period of time. And I think it's 3 years, but don't quote me on that. I could find out about that. It doesn't say the forgivable year, but it is forgiven after a certain period of time. So two options on this program. If we stay within the conforming loan limit, which is $647,000, we can go. The second is forgiven, and the second doesn't hit the debt ratio. This program, again, it's an FHA first. It doesn't have the conforming, so there is mortgage insurance on this. And there's also income limits for this one. All right. So again, for the first option where the second is forgiven, we are limited with the income and the loan amount for the Los Angeles market. Certain pockets of Los Angeles, well, most pockets of Los Angeles markets. It could be great for Palmdale, Riverside, San Bernardino areas. And also some of the areas in San Fernando Valley, there's some pockets that still, you can find a condo for $300,000-$400,000. So it's a pretty good program for that. But overall, we are limited when it comes to the forgivable second because of the loan amount $647,000. Now the other option on this one, the second option, it's where you guys could see it says it could go up to $947,000. Now that opens up some options for us here in Los Angeles area, especially or Orange County, in general, most of California, because we can do $900,000 first, and there's more options available. And the good thing with that is the income limit is higher on that too. So we're not limited with the low to medium income limit on that. We can go to higher loan amount, and the income limit, I believe we can go up to $158,000. So it is doable. The only thing with this one, yes, there is mortgage insurance. The second mortgage actually is amortized over 10 years, and there's a payment attached to it, and that payment hits the DTI. So borrower's income has to qualify them. And how is the second mortgage calculated? Let's say the first mortgage is at 5%. The interest rate on the second is 2% above the first. So it's going to be 7% First one is 5, 2, that's plus 2, that's 7, and it's amortized over 10 years, and that mortgage payment actually is calculated within the debt ratio. So it kind of lowers their borrowers' affordability options. But again, from the income perspective, we can go up to $158,000, and from loan amount perspective, we can go up to $947,000. Okay, so it's most of these programs. I also want to add that most of these programs they do require homeowners education. It's usually $75 to $100, and it takes about 45 to an hour. There's a site they log in, they complete the education, and they receive a certificate, which they send it to us to send it to the lender. Okay, most of these programs will have that option. Okay, any questions so far? Okay, good. I don't see any questions. So just to recap, those are the two main programs that I wanted to focus on, just to keep it easy and simple. And I know this is a lot of information for someone who doesn't know the guidelines or anything like that. It gets a little confusing. That's why the most important step is planning and the mortgage journey. I put a lot of emphasis on this one. Every time I talk to my borrowers, this is the most important thing I discuss. They talk to me about, of course, everybody wants to ask about the interest rates, but I do answer that question, but I also spend a lot of time guiding them, educating them in terms of to plan their mortgage journey. If they've got certain amount of cash money saved, they can't just take that cash money into the escrow and deposit it and start the purchase process. They need to plan what, how, and they could turn that money into usable down payment for purchase purposes. So I hope I said that in most professional and legal way possible. Okay, so they need to know how to turn that money into usable cash money for purchase purposes. Okay, so and there are ways to do it. It's nothing illegal about it or anything like that. It just requires planning, intelligent decision making, and understanding the mortgage journey. Okay, I have one file right now, which I did tell them all these, and they send me the earnest money deposit. Escrow actually sent me the earnest money deposits, and there was about 7 different deposits to escrow. One of them, they actually took cash to the bank and deposited into escrow's account. I'm like, escrow accepted that. I don't even know how they accepted that money. So unfortunately, on our end, we cannot use that. It's because it's not sourced, it's not seasoned. Okay, so small stuff like that makes a big difference in the process, and that's where educating our clients and planning ahead. That's where the whole process comes in. So from the borrower perspective, you need to know the process. The first step is, of course, is to get pre-approved. Once you get pre-approved, you need to stay organized with all the documentations required, or all the documentations that we base your pre-approval from. So you need to update all those documents as time goes on, because we can get you pre-approved today and you can find your house, let's say 3 months or 4 months down the line. So that pre-approval has to be updated every month. We need to have updated pay stubs. We need to have updated bank statements, And if your credit report is over 60 to 90 days old, depending which lender we're using, we need to update the credit report as well. The one other main important thing throughout this process is, let's say we started your mortgage journey today. One of the things you need to understand, or the borrower needs to understand, is their credit is critically important factor of the mortgage approval. So if we get you approved today based on your today's credit, and 3 weeks down the line you go down and lease $1,000 car per month, then that could jeopardize your today's approval. Okay, so stuff like that, I tell my borrowers, if they're going to do anything like that, they need to notify me at first. If they're going to move and transfer any money from the accounts, they need to notify me first. If there is any large financial decisions that they need to make, whether from the 401k, from their anything has to do with their finances, they need to discuss. I'll give you guys an example. I was doing a refi, which we just funded it actually yesterday, for a young guy. He was like 28 years old, making really good money. He signed the application. I did his purchase last year. I did a refi this year. Believe it or not, we just got it before the rates started going higher. As I submitted the file, I got a text from him a day later saying that I'm at the Mercedes dealer. I'm leasing a new car. So I picked up the phone right away. I called him. I said, we're in the process of getting you a loan. I have your rate locked. What's going on? Because I know he's got a certain amount of payment on his credit report. I said, what's going to be the new one? And believe it or not, the new payment was going to be about $2,200. I said right away, that's going to jeopardize your loan. I mean, you're not going to get, if you have to make a decision, you're going to get the car right now, you're not going to get the loan. Or you have to put on the car, get the loan, and then. The car salesman wasn't very happy with me. My borrower, he followed my advice. He did not lease the car. He was almost done. Everything was done, $2,200. They were just going to sign the paperwork. We just funded the file now, yesterday, so he can get the car from now on. That really doesn't matter. But some borrowers listen, some borrowers don't. But from our perspective, we have to give that advice and guidance to the borrowers. And I think that's important, especially when it comes to finances. This is the largest finance transaction they're doing, whether it's a purchase or a refinance. They need to be handheld, educated, and most people go through a lot of stress throughout the home buying process. What I try to do, and what our company tries to do, is bring that stress level down as much as possible. And one of the ways we are able to do that is if we have planned in advance, if we are ready to go in, we've underwritten perfectly, we've got a pre-approval that is solid based on the income, based on the credit, based on the assets. So we have the confidence to go in, say, boom, we can close this file. And so that's one of the ways we can minimize the stress level. The other thing I tell my borrowers, for example, is, they ask me how is the process going to be. One of the things I tell them, it's a two-way street. The lender in today's environment, especially after 2008, 2009, they're going to ask you for a lot of documents. Some of the documents are not going to make sense. For some, you're going to hate me, but it's not me, it's the lender. And if you follow my instructions, what to do, and if you provide everything on time, then things will go smoothly. But if you fight the system, then that's when you start creating issues. Again, some of the conditions sometimes these lenders will ask, totally will not make sense for us too. But at the end of the day, we need to be focused on the end result rather than the journey. Okay, so staying organized is the key. The next stage, of course, is to find the house. If you're a realtor, you got to work with your clients to find a house. If you're a borrower, you have to work with your realtor to find the house. And once you find the house and you like it, you have the solid pre-approval to make an offer. Okay, so those are basically the main planning journey. And just to recap, it's, again, the first step, you need to get pre-approved. Meet with your lender to get pre-approved. You shouldn't want to sign a contract, binding purchase contract without pre-approval, unless you're a solid W-2 borrower making $1 million a year with, tons of assets, 720 FICO, that's a different story. And you have all your documents in one place where you could, transfer it to the lender, boom, in one click. That's, but I would say 95% of the borrowers are not in that stage, unfortunately. Okay, so what are required for the qualification? Let's just quickly cover those areas too. Regarding the 100% down payment programs, all of these programs are full doc programs, meaning they require tax returns, W-2s, pay stubs. So all the income documentations are required. If they are self-employed, and they're using their self-employment income, they need 2 years of business income. If they're a corporation, they need 1120S. If they're Schedule C, it's going to show on their basic 1040s. So these are full doc programs. They're not stated. They're not bank statement programs. They're full doc programs. Okay, so income is important, and then credit. Credit is analyzed. We have to run the credit and analyze accordingly based on the accounts, closed accounts, derogatory accounts, mechanics liens, and all that. Debts once we pull the credit, again, debts are important because of the debt to income ratio. And of course, assets. Even though it's a no down payment program, borrower does have to have some money for some reserves. Depending on their FICO, sometimes we do not need reserves. But again, we do ask that we get 2 months of bank statements just so to see what their status is. And also, there's no down payment programs. Let's say borrower doesn't have any money down. Well, if they want to put an offer, they have to put earnest money deposit into escrow. If they have no money down, they have to get that money from someplace, correct? So they actually need to plan that accordingly. All right, they could get a gift from a family member or anything like that. So that's one of the items that isn't talked a lot, but that's very important. But it's doable. I mean, I haven't seen anybody have an issue with that. The only issue I've seen in that area is, oh my God, we didn't know that we need to put that money down. Well, we can get it from someplace, but we need a few days. So, but if they know in advance, they could plan that accordingly. This is just basic information for realtors. This is, it's very basic. But if for home buyers in the webinar, I want to cover the parties of the purchase transaction. You've got the realtor, and I put realtors first because ultimately they're going to find you the house. We got the mortgage broker second. You want to work with us first as well, but once you get the approval, then your main job is going to be with the realtor to find that house that you like. And of course, once you find the house, then we have the escrow company, title company. You got to have homeowners insurance. And if it's a condo, they have an HOA, then you're going to have a homeowners association fee. I mentioned these here because I'm going to quickly cover the fees and associated with the purchase transaction. And I want you guys to see where certain fees are going. Most of the fees are going to go through this following departments. Because unfortunately, most borrowers, they look at the fees and they think everything is going to the broker or to the lender. But I just want to cover some of the items on the fee sheet. In fact, next time I'll bring an example of a estimated fee sheet, so that way you guys could see different fees and where each one goes. So the closing costs are basically the following. You have the lender fee, the company who's going to lend you the money. They usually have their underwriting fee, tax fee, flood cert fee. Then you have the loan origination fee that goes to the broker. Sometimes you're not going to see anything here if just so you guys know, the broker gets paid in two ways. Either the borrower pays, and that's where, let's say, when you talk to the broker, say the broker says we charge 2 points for this loan, and you are paying, you as a borrower paying for that 2 points. That 2 points is going to be part of this closing cost, and you're getting, let's say, 4.5% rate, or the broker is paid by the lender, but then the rate is going to be a little bit higher. So let's say the borrower or the broker offers you 5% no point. That means the broker is being paid by the lender. They have to be paid by someone. And that when it's a no point, then you're not going to see that broker's compensation on the closing cost. Okay, so assuming it's borrower paid, that you are as borrower paying, then you're going to have the loan origination fee. And let's say the loan amount is $500,000 and they're charging 2 points. So loan origination fee is going to be $10,000. If they're charging 1 point, the loan origination fee is going to be $5,000. Okay, and then credit report fee, if applicable. We do not charge for credit reports, so on our end, you're not going to see that. You're going to have appraisal fee. Again, that's a third-party fee. Every loan that, especially on a purchase loan, and especially the 100% down payment loans, you're going to have an appraisal requirement. And usually they range from $650 to $1,150, depending on the price range and location and all that. Then, of course, you're going to have escrow fee. And on a purchase transaction, escrow is decided by the seller or the seller's agent. So the escrow fee could range. They range based on the loan amount or the purchase price. Okay. And escrow fee is going to have a bunch of other fees. Like you have escrow fee, you have document preparation fee, you have escrow wire fee, escrow overnight delivery fee. Then you're going to have the notary fee, public notary recording fee. Those are part of escrow fees. Okay. And then, of course, you're going to have the title insurance. Title insurance is basically it's giving you as the buyer assurance that the title that you're receiving on that transaction, it's clean. It's there's no liens, that after 2 months or 3 months or 4 months, no one is going to knock on your door and say, hey, I've got a lien on this property. Part of this property is mine. The title at the time of that transaction is giving you assurance that your title is clean. Okay, it's very important. And title insurance fee is based on the purchase price and the loan amount. It's basically loan amount. So if the loan amount is small, it's of course insurance is smaller, and as it goes higher, it gets higher. Again, that's a separate third-party fee. Then you have, those are the actual fees. Then you have the prepaids. What are prepaids? Prepaids that are, they're not fees, they are payments that you have to make upfront for the purchase of that property. For example, insurance. You got to have a homeowner's insurance to purchase that property. The lender is not going to give you a loan if you don't have an active homeowner's insurance. And on a purchase transaction, you got to have a 12 months of homeowner's insurance. Okay? And it has to be paid up front. You can't make it through payments. On a purchase transaction, you have to be paying your homeowner's premium, everything up front for the next 12 months. Okay? So that's a prepaid item. And the next prepaid item is the property taxes. The prorated property taxes are prepaid. And the next one is the interest, the mortgage interest on the new loan. For example, if we close the loan today's June 9, and your first payment, it's going to be June, July, August 1st, okay? But the lender needs to collect the interest from today until the end of this month. So that's prepaid. So on your statement, you're going to see, let's say, and just to keep it simple, it's June 30. June 30 minus June 9, that's 21 days left. So you're going to see 21 days of interest on your statement. That is a prepaid item. Again, that's not a fee. That's the lender is getting that. That's an interest that you're paying to the lender. Okay? And mortgage insurance if applicable. Okay, if it's FHA, then you're gonna have mortgage insurance. So those are the breakdown in general of the closing costs and the fees associated with the payment transaction. That's about it. I'm almost done. I don't have much. I wanted to do this in like 30 minutes. I know it's after hours, and I appreciate everyone joining us, but we went a little over. We went to 45 minutes. Hopefully, it was informative for you guys. But if you guys have any questions, I'm going to write my email address. And let me write my phone number as well. So that's my email and my phone number. You guys could contact me anytime. I'm available. If I can't help you, I'll get an answer to get back to you, or I have one of my loan officers get in touch with you. All right. I don't see any questions. I'm just going to keep it open for about 30 more seconds. And if I don't see anything, then I'm going to call it a night and wish you guys a great night. Thank you again for joining me. And we'll be having another webinar, hopefully in 2 weeks. I'm going to be doing it on a couple of other different programs, just so we mix it up a little bit. Yeah, I don't see any questions. So yeah, thank you again, and have a great evening, everyone.